South Asia Committee of the International Law Section presents the Global Lawyers Summit in association with CNBC TV 18.
Welcome to all the participants. Let me start the panel by invoking Buddha. You must have read this quote on social media from Buddha that the root cause of all suffering is ignorance, and one who learns to elevate this ignorance gets enlightenment. So what Buddha had presupposed was one has to suffer before one attains enlightenment. Today, we are going to the next level of what Buddha had suggested, and we are going to achieve the next level of enlightenment by learning from suffering of others. So we don't need to suffer ourselves to learn. So what on this panel we are going to do is share the goof-ups or the issues that had come on PE M&A deals. We are going to share about 10 to 15 examples and live real-life case studies, with all of you, so that when you are working on deals, you don't have to go through the same issues again. So let me, the way we are planning to kind of divide this panel is into three parts. First part will be, we will share, the real-life examples on due diligence, on what were the issues that came up on due diligence. Second part would be on documentation. And third part would be on dealing with the regulators. And, the format was decided based on the fact that, I think we all can talk for hours, but I think ultimately what's important is you should be taking something back for the valuable time that, you are devoting in attending this panel. So we are going to make it very practical and more experiential so that you can take back as much as possible from the panel. So with that, let me just start with, maybe I can start the first example that I faced on a due diligence, and this is a very interesting one that we faced. So this was a deal that we were doing where a US investor was investing in a US company with an Indian subsidiary. And we were the Indian counsels, and there was a US counsel also on the deal that was representing the investors. And interestingly, we were very close to signing off the deal. And the US law firm partner on one of the Fridays went for social drinking in a bar. And he was sitting there, and, there was a girl who was there, and he started talking with that girl. And after half an hour of conversation, the girl generally asked that, what's happening? What are you doing these days? So this guy told that, I'm working on a deal where I'm, helping one of the investors to invest in this company. And that girl was shocked. She mentioned that, the founder of this company had molested me. And this never came out, obviously, in any diligence or anything, because it was all kept under the carpet. And we actually had to inform the investor about this, because this was a significant event that happened prior to the deal signing, and nothing was disclosed by the founder. And when the founder was asked this question, the founder kind of downplayed it and said, yeah, there was, it was all frivolous complaints, and we had set up an investigation which was headed by the head of HR, and, clean chit was given to me. So now there is no issue. Now the point is that this founder was of the Indian company where, POSH Act is applicable. And as per the POSH Act, you have to appoint a committee which has an external member also who is a woman. And so all those things were not followed. So it was a big red flag for the investor, and it kind of became a big issue, and the investor had to actually take a call where either the founder goes through the process which is required as per law, or they don't invest in the company. And the founder said, I'm not going to get into this discussion again. It is done and dusted 2-3 years back. And then the investor actually backed out from the investment just based on this one issue. Because if something like this happens later, and then the investor is questioned that you already knew about this, there is no face saving for the investor. So this is one interesting example on how due diligence happens even in, on Friday evenings also, when you are out of office. But I just wanted to share this one interesting case that we encountered. But I would love to hear from you, Ria. Anything based on your experience on due diligence?
Yeah, sure. So we actually had a recent example of a company that we were looking at, which was operating in the food and beverages sector. And certain FCPA compliance issues were identified in the diligence. And that itself was unusual because usually FCPA type of issues, do not get picked up in diligences because at the end of the day we know that the data being assessed is what is being provided by the company and the management, and these are usually issues which are brushed under the carpet. And so one, it was equal parts good and troubling to see an FCPA issue being picked up in a diligence. And then I think, when something like that happens, our first reaction is, because especially when significant time and effort has been devoted to the deal already, to see what can be done to continue with the deal despite this. So initial reaction was to, outline what steps the company should be taking to regain their compliance status, what structure changes we may want as an investor to before proceeding with this investment. And those aspects were, though on further thought, seem to be limited, because I think when you have compliance issues of this nature, you do need to look at sort of all facets of how this impacts, legal, tax, financial, commercial. Because I think if these kind of non-compliant activities, you are getting a target company to stop it. And this will be quite prevalent in developing markets and growing economies. Then there could be a potential impact on the business or on the, profits of the company even, where there is a direct linkage to the money that the business is essentially making. And on examining those facets, we eventually decided to, pull out of the deal. And it didn't seem worth it because I think it was one of those situations where, lawyers often say that due diligence is, even when they find issues, it's just like, you feel that pressure to still just do the deal, irrespective. But I think this is a fine balance that has to be drawn between, commercial objectives and what is commercially attractive to your investment team, for example, versus, following your internal policies and laws and maintaining compliance. And of course, like ESG especially, we know has been an increasing concern for investors in recent years. So yes, eventually we did not proceed with the deal in this case.
Yeah, it's a tough balancing act. Yeah. Moksha, you want to go next?
Sure. Thanks, Nishal. So I'm going to start with an anecdote and then maybe, we'll. So I was speaking to a very storied investor once and I was telling him that, how often do you actually see a deal fall through on account of diligence issues? And, my sense at least was that doesn't happen very often. And he turned to me and he said, look, of course, we understand that the diligence has certain outcomes and those need to be met. But from his perspective, the time that he spent with the founding team was of more importance to him because he could get a sense of what kind of people they are. And that sort of ties into the point that you made. At the heart of it, whatever kind of document you have and whatever kinds of rights you actually negotiate, if you are stuck with a bad promoter, it's an uphill climb. So from that perspective, even if you pick up smaller issues or if you see behavioral issues, somebody is being a bit evasive, investors do need to think very, very seriously about these issues very quickly because you do have enforcement in India and all of that is fine, but it's uphill. So in that sense, it's important. The two issues that I have seen lately, which are interesting, was one, a private equity fund which was trying to sell out of an investment, and they instructed us, we need to do a diligence and we need to move on and find buyers. When we looked at their shareholders agreement, we realized that the confidentiality provision there actually did not let them share information with a third party, and that happens more often than it actually should. Which is that because there are templates that have been negotiated in the past, somebody's not thought through things. I mean, obviously, if it's a significant or a sophisticated enough investor, these sorts of things get picked up, but sometimes they don't. So that was one issue that I had. Maybe with that I'll pass on.
In fact, it's always said a good document can never replace a bad promoter, and a bad document can, still take care of a good promoter. So Shobita, you want to go next?
Sure. So my example is actually one where the deal went through. This was almost 20 years ago, and it's an example that I still think about, though. We were acting for a private equity fund that was doing 100% acquisition of an automotive parts manufacturer. And diligence was done, documents were executed, deal went through. There was a holdback, and we were sort of waiting to hear back from our investor client as to whether there'd be any claims under the holdback. And about 12 months after the acquisition, the client came back to us, and their concern was that in the running of the company, they had noticed that the revenues of the company were not sort of aligned to the projections and what they had assumed when the company was valued. And the reason for that, they pointed out, was that a lot of the long-standing customers of the company had stopped buying the product from them as much. And the reason for that was that the component that the company was manufacturing had undergone a design advancement. And so the industry had moved towards the design advancement. And obviously this company was then not servicing that design advancement, and so people were not buying the product. And, the investor asked us, surprising, it didn't come up in diligence, it didn't come up in management discussions. We would have expected something like this to get picked up, and they wanted to look at the reps and warranties and see, all material information must be disclosed and so on and so forth. And so we looked at the reps and warranties, and of course there was language that said that if there's material information that you think is pertinent to us making this acquisition, it's all been disclosed. And there was no disclosure against that. But in the section on material contracts, the promoters of the company had disclosed that some material contracts had not been renewed because the industry was moving to this new product. And at that point in time, certainly everybody felt like they had egg on their face, because here it was in black and white in the disclosure document in your deal Bible. And it's a lesson that diligence doesn't end at any point in time. That disclosure should have been discussed more. The implications of that should have been looked at by the deal team much more. And I'm very sure that it would have impacted valuation if that was done. But for whatever reason, it didn't happen. And so now we read the disclosure letter 500 times because you want to make sure that there are no such surprises in there.
Interesting. Gaurav?
Yeah, I think my examples will be always, more, I would say, founders driven, because as a banker, the things I have dealt with in my previous avatars, I tell you, sometimes you just give up on the documents. You don't want to believe on them at all. You talked about posh cases and all. I'll tell you an example, and rather I'll give you two, and that will tell you how integrity of a person can be the key factor for doing a deal. Absolutely, a great company we were looking at, we were facilitating, an acquisition. So the guy was an Indo-American guy in India for more than 10, 12 years. Everything fine, background checks are absolutely clear, nothing bad. So during the conversation, there comes a twist that we say that we have similar business in US, a separate entity. Let's merge these two in one go, to save the transaction pain and costings and all. And that guy suddenly becomes jittery. I'll not, and offer to that guy is you become the CEO for the joint entity. So phenomenal offer, nobody is going to skip it, but that guy backs out and says, no, I don't want to do it. So that kind of rings the bell. Background checks were clear, you don't have any reason to believe it. Then someone suggested us there are specific agencies, those are ex-RAW, FBI, intelligence services, they can help you with something. And they carry out a search. Believe me, we got a 80-page report. You guess a case and it was against that guy in US. Guy was deported back, everything. And suddenly you realize you're talking to a different person. And that day we realized the founder check Forget the background check. That proper agency check is going to happen, come what may. And that the cases were sometimes so heinous that you can't even assess. And normally a deal lead time is easily 6 months, 5 to 6 months. You're spending time with that person day in, day out. You can't even believe that you would have been involved in violence, having some weapons at home and whatnot, and you're like such an aggressive guy. How can you do that? So these kind of examples actually create a trouble. And now I'll give you another example where things were like hand in glove situation by the seller, by the founder, the existing shareholder, by the seller. What they do is everything is fine, like you were talking about disclosure letter. Perfectly, everything disclosed so well, nothing wrong. And now we were bitten once, so we knew that what is to be done. So company in Europe, and there's some laws where you file for the winding up petition. If it is not admitted, it never comes on the record. So the difference between the existing shareholder and the founder was so much. And and I'll tell you that a similar example which you were talking about, that somebody goes out socializing. So we like the company. We thought that now everything background check is clear. Let's go for it. So we start talking to a lawyer, and generally you have those verticals, right? As the luck would have it, that particular vertical head was on leave. So we spoke to the guy who was heading litigation, but a managing partner. We said, we want to acquire this company. Can you help us? Well, yeah, I know this company. I represented them in some case for winding up. I said, really? How did that happen? Said, no, they have filed winding up petition twice, and luckily with the mutual consent that got withdrawn. Now differences are sorted, but there'll be still some liability which may come up to the tune of, say, $5-6 million. And the deal was of $1 million. I said, no, nothing's happening. So, that 10x or 6x kind of a liability was kind of brushed under the carpet. Wow. And with a hand in glove. So I think this due diligence, every deal teaches us that keep extending the scope. And obviously our lawyer friends get a benefit out of it. So.
Yeah. Interestingly, one of my first deals that was in real estate sector, what had happened was one of the domestic venture capital funds was investing in a company which had the development rights to develop a parcel of land. And that company had got development rights from one of the group entities. And that transaction had happened in 1995. We were doing the deal in 2006 or 7. And when we started looking at everything, we found out, and this deal was for 125 crore. So the investor was investing 125 crore in the project SPV that was going to develop the project. When we looked at the documents, we found that the development agreement through which the development rights were transferred was not stamped. Now at that time, the stamp duty was about 5%, and it was a nominal amount in 1995. When we looked at the total amount from 95 to 2007, 2006-7, when we were doing the deal, along with the penalty and everything, the stamp duty amount was coming to 150 crore, which was even, more than the investment amount. And obviously, it was a no-brainer that, we can't do the deal because without the document through which the title was transferred, that being properly stamped, tomorrow anybody can question that development agreement. So this was another interesting thing. Now, the one small thing, if you miss out, when we are doing diligence, can become a huge issue, almost full write-off of the investment for the client, right? So I think this was something quite interesting. But if any of you want to share anything on diligence, otherwise we can move to documentation.
Only other thing that I'll say is that, some thought needs to also be given to the nature of the beast here, right? So at least for me, I do a lot of work in the technology space, work for technology companies, either on the investing side or on the sell side. All tech companies have, of course, the founder stake, then you have investors, and then there's a long tail of people who've showed up at some point of time and taken up tiny, tiny stakes, right? So if you're going to be doing an acquisition, suddenly you're looking at and trying to figure out there is an NRI who has bought a small stake. Where is he? Is he still alive? So, and nowadays you have these numbers are in double digits. You have 20, 30, 40, 50 investors. So if you don't plan for this early in the diligence process, it can become a challenge on the last date. That's a problem that I've...
Sure. So moving on to documentation, again, one of the most important part of the deal making. And ultimately, if things go south, then these documents are going to be looked at by the judge or the arbitrator. So, what are the practical real-life examples that we have seen on goof-ups in documentation, which kind of became a big issue later? So, we'll be discussing that next. Riya, you want to go next?
Sure. So this was something that seemed like a very basic provision of any investment transaction document, which is your conditions, precedent, and closing actions. But recently, we've sort of pulled back focus on these. These are not usually, as in the the lead-in language or just the initial provisions of these clauses are not really controversial usually. But we recently had some not so great experiences where the counterparty was actually trying to drag the deal through the long stop date on purpose, either to use it as a pressure tactic to renegotiate terms of the deal for better pricing, or in one case it was because it became known that the company is expected to declare a significant dividend and they wanted to be shareholders on the record date and then exit. But of course, the idea of these, especially closing conditions, is that they are actually meant for the benefit of the investor. Because principally, of course, the idea is that these are certain conditions that the investor will need to see fulfilled before they proceed with the deal. But, it was the other party sort of misusing it for their benefits for different agendas. And so we've recently tried to pull back focus on this because these were clauses which usually may not, be paid a lot of attention during negotiation. So you have language like commercially reasonable efforts to fulfill conditions precedent as soon as possible, which is something that you may feel comfortable with because this is not something that is, you're not expecting a counterparty to behave that way. But of course, with these experiences, we've sort of now made it a point to have very watertight language in these clauses so that there's absolutely no loophole or, scope of abusing the provision, essentially.
In fact, just recently we were involved in one of the arbitrations for enforcing a non-binding term sheet. And this was an interesting example. Exclusivity provision was binding, but all other provisions were non-binding. And the good part was that the arbitrator literally went into the conduct of both the parties, in spite of the fact that it was a non-binding term sheet. The arbitrator went into when did you send the SPA draft, when did the comments come back, because what had happened was the seller was also negotiating with another party at the same time, when compared to the party with whom they had signed the term sheet. And the proposed acquirer in the term sheet sued the seller for not reverting on time, not sending the DD material on time. So all those things kind of were looked at, and actually the hearings went on for 6 months. Ultimately, the arbitrator took a view that, in non-binding term sheets, if we start making it enforceable, then, hell is going to break loose in the deal world. So took the view in favor of the seller, but also because there were 2 or 3 things with the proposed buyer under the term sheet didn't do it on time. Otherwise, there were chances that, something more could have come out of that ruling. So I think one lesson to learn from this is that don't take non-binding term sheets lightly, right? It's not that if it's non-binding, we can do whatever we want. Ultimately, the arbitrator or the judge will also look at the conduct of the parties, even in a non-binding situation. And that's something that was interesting to learn from that deal. Shobhita, you want to go next?
Sure. I think my sort of experience is sort of similar to what Riya was talking about, which is specificity in a contract. And I know we try to balance out drafting to say, let it be simple English, don't get into very complicated clauses. But the example that, I had come across is it's very common to restrict a private equity investor from selling their stake to a competitor. And your shareholders agreement will typically have a list of these competitors, or there'll be a definition of a competitor. So in my particular example, there was a list of some 5 competitors that were going to be placed in the shareholders agreement, and the founder requested the ability to revise the list of competitors on an annual basis. So it said list of competitors will be ABCD to be revised annually by the company. And for many years, there was no revision to the competitor list because everything was going great. And then there was an exit discussion, and the exit discussion was not going so well. And the founder wasn't happy with the incoming investor. And what happens? The investor receives a list of competitors as the revision annually with the name of the strategic investor on that list. And what we learned was, one, think very carefully about whether you want to agree to something like the revision of a list of competitors annually. Most industries don't have such a rapidly sort of revising list of competitors, but also when you say annually, one thing that I would strongly recommend is put some guardrails around the timing, because look how this got gamed completely unintentionally. So I think specificity in how you think that clause is going to be performed and making sure that in simple language you convey that is very important.
So this was actually founder favoring. We faced a different situation where it was against the founder, same competitor issue, and actually the founder's company was taken over based on this provision. So this is actually a Delhi-based company where investors had free transferability of shares provision. So there was no ROFO to the founder or to other investors. And what happened was one large Indian business group became interested in this company. They wanted to acquire this company, but the founder was saying no, that I don't want to sell. This is something I've nurtured for 10, 15 years and I want to grow this company. And this group has been very aggressive in India. So what they did was they actually used this competitor definition because the investors were free to transfer their shares except to a competitor. And competitor definition at that list, plus there was also strategic investor also can't be one of the purchasers. So you can't sell to competitor, can't sell to strategic. Where the issue came up was this particular fund, which then partnered with the hostile acquirer. This fund sold its stake, which had all the reserved matters, board seat attached to the shares, to a venture capital fund sponsored by the strategic investor. And in the definition of competitor, there was a carve out for any fund or pooling vehicles. But this was not there, that if that fund or pooling vehicle is sponsored by strategic, then it should still be considered as competitor. So these little things in the definition was used by the investor, and this stake was sold to the business group, to the venture capital fund sponsored by this business group. And in 6 months' time, the founder had to sell the company to the venture capital fund. So this is another interesting on how little things can, 15 years of effort and hard work can just go for a toss. Gaurav, any of your experiences?
Yeah, so I think my experiences are, it's like, I can articulate it in a way that it's every time a signed document I revisit, it's like visiting a haunted house, some skeleton will pop up. So, and you feel that you would have buried it better. So, I'll tell you, and in current scenario, when there's so many complexities involved, what happens is that you try to give exotic solutions, right? You're not doing a plain acquisition. Suddenly someone comes and says, let's do BTA. Now, in a BTA scenario, you are marrying, a legacy document with a new set of documents where, very selective migration is happening. And we have actually faced a situation where everything is completed and there were certain CPs which was drafted in a way. And these CPs and CS, I have always realized they're like weapons which are, of mass destruction somehow used in legal language. So, those CPs were drafted in a particular fashion, and then the stock was supposed to get transferred, but the stock was hypothecated to a banker. Banker said, first clear my loan. Loan cannot be clear unless BTA happens and the money comes in. So, and again, I'm trying to maybe, say that is there was just a small miss in overall checking cross-referencing or drafting a particular document. Just somebody ignored a practical scenario, and that's how the deal got logged. You can't amend it. Banks are absolutely inflexible about it.
Yeah.
And then you have the document again and keep reading it if you can't find something, and that's how deals. And the problem is that later on you amend it, you do a couple of things. I think my important point here is that the cost of doing that, one more cycle is so significant sometimes that it overall delays the process, and unit economics gets disturbed.
Yeah.
So I think that is what I have always taken away, that try to handle it at one shot rather than doing multiple iterations to it.
In law we always say, you missing one comma can put a full stop to the deal.
Yeah.
So, it's
Seen that enough.
sure. Moksha.
Thanks so much. So I'm gonna talk about two different things, and one is a pet peeve I have, which is generally so at least for the VC space, and goes on to at least for tech startups, it's an issue that continues, which is that there is a high degree of commoditization or standardization in documents, which is a good thing because it does speed up transactions, but it can also sometimes be a bad thing because it sort of helps. It tends to lower your guard, and then you stop looking at things as carefully as you sometimes perhaps should be looking at. Now, I'll give you an example. So, you have club VC deals or club PE deals where you have multiple investors come in and they then negotiate rights. They are also working off an existing draft where people have already negotiated rights. So what do? You say, okay, all of these reserve matters will now go to the investor majority. Very often or at least in some cases what will happen is that some investor or the other at some point will find out that they have been disenfranchised, that they actually have no ability to stop something very significant from happening which materially impacts their business. So my only point is, I'm not saying that there shouldn't be standardization, but there is a need to at least carefully revisit some of these things every now and then, and with the reality being that it means that you need to spend more on lawyers, so maybe do that. But so that's one. So the other point that I wanted to make is on M&A deals, which is so on a lot of M&A deals in the tech space, there is a need to bridge valuation. You have a seller who believes he should get X, and there's a buyer who thinks it should just be something else. So you end up using some sort of an earn-out arrangement or some sort of a formula-based payout for some sort of staggered sale. Very often these are agreements which have some elbow room built in. And my experience has been that they create a lot of issues because very often there is a limit to how much you can actually legislate for the future, and you end up with a lot of disputes in the space. We're doing a few already. So, and in the current environment where you have rising interest rates, objectives are changing, intents are changing. So these can create issues. So it's important to carefully negotiate earn-out arrangements.
Sure. So I actually had a very interesting experience in early part of my career where I was negotiating a deal for sellers in an M&A deal. And there was a term sheet that was signed which was obviously non-binding but with binding exclusivity provisions. And the term sheet was, I remember it was signed sometime in February, first week of that year. And it had about 45 days exclusivity provision, which was ending on a Friday. So the 45th day was ending on a Friday. And, the first draft that came from the buyer's side was almost 150-page SPA. And, my client freaked out that, this is so long and, why don't you go back and tell them to simplify the draft and send it back, because this is a 100% sale. We don't need so many complex provisions. So we went back to the law firm on the other side, and the next draft that came was a 145 pages. Like, I don't know, they maybe reduced the font and managed to reduce 5 pages from 150 to 145, but pretty much nothing changed. We kept on negotiating 2 rounds, 3 rounds, and for every small point, they kept on asking for, kept on coming back with unreasonable demands. And finally my client got fed up. And this was on this, I think around between 40 to 45th day when the exclusivity was going to end, we had this discussion. And what we told him, he said that, I might have another buyer who could be willing to buy this company. So what we told him is that, listen, this is expiring on Friday. And I don't think either the banker or the other side law firm is going to come back and ask us for extending the exclusivity. So why don't we do one thing over the weekend? Let's see what we can do. Because most probably on Monday, Tuesday, they'll come back and ask for extension of exclusivity and other things. So actually, and this is like, you can make a movie on this, because on Saturday, the client negotiated all the commercials with the new buyer. So he identified a new buyer. That's a big business group in India. They finalized the commercials in first half. Second half, I was instructed to draft the SPA, which we sent by Saturday night. Sunday morning, we all met. By 2 or 3 p.m., we closed all the points in the SPA. And we signed the SPA by evening on Sunday. And on Monday morning, closing happened. Right? So the deal that went on for almost 45 days with so many negotiations was with one acquirer was closed by the other acquirer in 2 days' time, including all commercial negotiations. And on Monday afternoon, the banker and the law firm called for extension of exclusivity, right? And we had to tell them, you're slightly late. We already signed the deal. And, so this was very interesting. And this is actually now becoming more and more of a norm, where, as, Ria also mentioned, sellers are getting offers from multiple sources, and they are also finding ways to delay the deals. It's not just the buyer wants to do the deal, but even sellers also want to delay the deal so that they can get better valuations from others. So this point, again, the major learning here is whether you are representing seller or the buyer, keep an eye on when the exclusivity is ending, because it can hurt you either ways depending on how desperate your client is for doing the deal. So I think that's on documentation. Now I think all of us know that in India, you can't take calls on deals without, taking both on legal view and regulatory view, right? And sometimes they don't match also. So it's very important that, the regulators are taken care of when we are doing deals. And now lot more deals are subject to regulatory scrutiny in India compared to what they were a decade before, right? So we have a in the last decade, the biggest danger in terms of the regulator, as we all know, has come from CCI, Competition Commission of India, where if the deals are about a certain threshold, you need to make that filing. And, there are a lot of issues in interpretation, and CCI's views are at times very different from, what the view industry is taking. Similarly, we have RBI for financial services, IRDA for insurance deals, SEBI for listed company deals. So day in and day out, we have to deal with a lot of regulators. And it's very important that, the communication with the regulator is appropriate so that it doesn't harm your deal. And that's the next, part of the panel that we are going to discuss on what are the major goof-ups or issues that, the panelists have seen while dealing with the regulators in India. So maybe Gaurav, you want to go first this time?
Yeah, sure. So I think, in the banking community or the corp dev community, they say that if you want someone to age faster, just put them to get an approval from a regulator. And, you'll see them that they're fading away. So, that's the reality of the deal. And not because that there is some delay. The point is the kind of queries and the kind of, resubmissions which are being asked by the regulator are getting smarter and, very, very strategic these days. So, and still there are some category of approvals, like there is some, we call it a hope approval. For example, if you want to really test your patience, ask for a PN3 approval. We have seen it, where acquisition has happened, partial stake has been transferred, company operation started, and, in hope that obviously it's coming. And unfortunately, the acquirer had some connect with the PN3 guidelines, some Chinese investor and all that. So we were still hopeful. Very big name. We thought it's going to happen. Everything went. Even reached at a stage where you're transferring another 30% and remaining. And the approval never came, and you have to, actually wrap up everything, and the deal had to fall through because there was no choice. Without that regulatory approval, it couldn't work. And if you want to really see the other side of it, and I'll tell you, if you go for listing today, for example, today SEBI is very particular that how you are determining the valuation, what are the KPIs, what are the multiples. So they start very smartly. They'll ask you, okay, you're this particular segment of company, you're a SaaS, you're a tech company, tell us your peers globally. They'll never say valuation, right? So you go and tell them the peers. Then they say that give their KPIs. Now link them to their multiple. Now you tell how your valuation is justified. So this is even in a primary round, right? And another problem, so I'll give you another example. For example, they'll say if you are holding more than 25%, you will be a promoter. So now all these funds become promoters by default. This is a case where their own company is going for IPO. Now, as I said, more exotic you go in M&A, it creates your life more miserable. So you try to acquire a listed entity, and the kind of a disclosures, the kind of a takeover code norms you are going to get, it's like sometimes the whole process is lengthier than negotiating the deal, concluding the deal, and by the time something else happens and some other acquirer is in picture. So these whole managing the regulator, or rather assessing what regulator is expecting from you, has become the key for any M&A deal today.
True. Moksha? Thanks so much. So I'm actually thinking of what Riya said, and I think that makes sense. So people use regulatory approvals as a part of the M&A process, sometimes to delay things and sometimes to self-sabotage, right? You don't actually want the deal to go through, then, So the one learning there for me at least is that that's possible, right? So you can actually, in a way, use the regulatory process to your advantage through the deal. You also have situations where you have competing interests who then write to regulators to try to muddy waters. And we've seen multiple instances where those have been challenges. Ultimately, the regulators do what they need to do, and they work within the framework. But those have been challenges that we have seen. So that's one. The other one is what Gaurav said, which is the PN3 issue, right? So there's an entire cottage industry of views which has sprung up around the PN3 issue. But the fact of the matter is, and we're seeing it in a couple of cases for regulated industries, that the government does actually want to know who each and every shareholder is. It's not a question of that, can you go with a X percentage threshold, etc. They're sensible and they understand that, that there are public shareholders and things like that, but they do actually want to know. At least that's been our experience in a few cases.
Sure. Priya?
So I think, on PN3, I think it's now also extended to government procurement, which we recently faced as an issue because it's not an investment related issue for us, at least, thankfully. But one of our portfolio companies was involved in government procurement, and as part of that process, as part of the information and documents that they had to submit, a whole host of information was asked of us as a majority investor in that company. And it was quite scary in a way to see the level of detail that they were seeking. And I don't know, it's also seemed irrational, certain things, right? Like, for example, when you reach a point where you are bound by confidentiality obligations, so there's a listed entity involved, what more do you want us to do at that point? And no one really has a clear answer there. It just depends on which case officer you're dealing with, I suppose, and what views they take. And another sort of difficult experience that we recently had to go through was with the CCI on a deal. And, for the difference between a Form 1 and a Form 2 filing, one would think that, there are objective thresholds on market share. So this should be a simple enough question for someone to answer, whether it's a Form 1 or a Form 2 filing. But even then, what the CCI views as market for a particular sector or for that deal, if that is different from your submission, then those numbers are not the same anymore. And so we had this experience where we had to do a Form 1 filing. And then we were asked to do a Form 2 filing as well. And had we gone for a Form 2 filing in the first place, we could have probably saved a good 6 weeks on the deal closing timeline. And I think that was also a good reminder that, of the importance of good advisors and how they can help you in these kind of situations, because there's that a good advisor, I think, would need to understand the distinction of, when not to be unnecessarily conservative, when to be reasonably conservative, and when to be practical and be on point for what your client needs from you. So I think this was one of those cases where a reasonably conservative view would have been to go for a Form 2 filing in the first place, if there was any grey area about what CCI may view as the market, and then we could have, saved a whole lot of time. And in some cases, when this elongated the process so much, you could potentially also lose a deal. So, it can have pretty grave consequences. So, yeah, that's a couple of recent experiences.
Shobhita?
So, I would like to talk about not really so much the regulatory approval process, but actually dealing with the regulator post and linked to how you do some basic housekeeping during the course of your investment. So, we had an instance where a gentleman was serving on the board of a portfolio company, originally as a nominee of a private equity fund. The private equity fund sold out, but because the gentleman was sort of somebody who the founder valued the advice of, he was asked to stay on. At that point of time, he was appointed to the board. There was a board resolution, forms were filed, and life went on. The company was closely held, the board was not very large, and at some particular time, the gentleman was asked if he would sign the financial statements of the company as a board member, which, to be helpful to the business, he did and he obliged. And then a couple of years later, there was a tax notice from the tax authorities, and he was named as a principal officer. And he found it so difficult to defend the point that he was non-executive. And one of the big things that we learned was you have to make sure that your ROC filings reflect that. You can go through the process of explaining to the regulator that, I'm not involved in day-to-day management and all of that, but it is not as effective as showing an ROC form that says, look, here I am non-executive. And so please don't place the same level of responsibility on me as you would with somebody who is actually involved in day-to-day management. So, some of these smaller things can really come back and bite you if you're not watching carefully.
Yeah, that's true. In fact, I'm sure some of you may have faced, but the RBI take on record letter, that is also so important. We have seen couple of deals getting delayed by at least 3 to 6 months because this letter was not on record. And what happens here is that usually when NR to NR transactions take place, where one non-resident is selling shares of an Indian company to another non-resident, usually there is no FCTRS or FCGPR form that is involved. But the issue that happens is when the buyer non-resident acquires the shares and later he wants to sell the shares, let's say to an Indian resident, few years down the line, at that time the AD bank will ask for the previous FCGPR forms for the original investor who had invested. And in couple of deals, those, the erstwhile, so the seller on the deal had not taken from the erstwhile buyer from whom they bought, and the erstwhile seller. And that's where this become a big issue where, the AD bank didn't clear the deal, and it took almost 3 months to get that letter from the Reserve Bank of India. And post that the deal happened, but obviously then, the negotiation on price and all those things come up, right? That, the deal got delayed and, we need to relook at the valuation, company's financials have changed. So some of these things become quite important when we are looking at, doing deals. Okay, looks like I think we have done a good job. So Thank you so much for your patience, and hope all of you have benefited from the session. Thank you, and thanks to all the panelists for sharing your insights. Thank you.
South Asia Committee of the International Law Section presents the Global Lawyers Summit in association with CNBC TV 18.